Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our podcast, my guest and I will cover basically every angle of real estate that you can think of, from interest rates to the economy to what's happening in Washington, what's going on with the Fed, the manipulation of interest rates, and what that means to you and your real estate and your real estate decisions. Joining me on today's panel, as always, is Louis Camerosano, who is a former school teacher, a former attorney, and a former general manager of a major real estate portal. Louis is often cited in the media as a real estate industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today, buddy?
I'm doing grand, Ryan. How are you?
I'm doing well. Obviously, I had a lot going on the past week or two. We've been talking a lot about the Fed and employment, unemployment, what that means to the overall economy. It's kind of interesting what's actually taken place this week, which I guess what we should start with, which was one of the bigger reports to the markets anyway, and carried a lot of weight, was that report that was put out by the ADP, which is the ADP National Employment Report, which basically said the private sector employment increased by 200,000 jobs in July. Now, obviously with that report, now we had today, this morning, the labor statistics report, which basically came out and said that there was only, 162,000 in July, and the unemployment rate edged down to 7.4%. So obviously we have conflicting reports there. We also showed that the average work week was down. I believe it was average hourly earnings was down as well. Seems like there's a lot more trying to be pumped out there that things are turning around, and that just really isn't the case. I mean, what's your take on this, Louis? I mean, this is obviously what we talk about all the time. It's like, they get one little piece of information, they run with it, which forced interest rates back up again this week, another quarter of 0.38%. Now, today, I would imagine we're probably going to get them to come back down a little bit based upon the information we have. But what's your overall take on the situation? First, touch on, what's going on with the employment situation. Then after that, we'll dive back into the Fed and what they talked about on Wednesday.
Okay, great. Well, Ryan, I think the report that just came out from the Bureau of Labor Statistics is not good at all. There's nothing to like in this report. As you mentioned, 162,000 jobs. Half of them are in retail and restaurant, which means more part-time work. You mentioned that the number of hours worked has decreased, which means more part-time workers. The wages have decreased, but yet spending is up by consumers. So none of this is going in the right direction. And also they revised downward last month's job numbers. So the amount of non-farm payroll that's being produced is low, and it shows that QE doesn't create jobs. Now, there was a slight bright spot in that there was an increase in some construction jobs related to the housing sector, but nowhere near the amount necessary to bring the economy back up in the labor market where it needs to be. And the most troubling point of all this is the unemployment rate may be going down, but that's solely a function of people leaving the labor force. And you have a labor participation rate tick down again, and it's at the lowest level in 32 years. So if you don't have people engaged in the labor force, or they're only partially engaged and they're making less money, you cannot claim recovery in any way, shape, or form when the people that are supposedly engaging in the recovery activity are engaged less, getting paid less to do it.
Right. Would you agree then that obviously these are more national statistics and not as much regional or even more specifically broken down into metropolitan areas, that realistically, in the smaller rural areas, not as metropolitan as New York, San Francisco, D.C., that these areas are obviously anomalies to the rest of the country, and that what this means to real estate is if, where there are jobs, it seems as though the real estate markets are doing much better. We've had rapid increases in appreciation of home prices. And then the surrounding areas elsewhere, though, where the jobs aren't as plentiful, and majority of the jobs are part-time jobs, that this is more or less that from now until into the foreseeable future, that areas that are metropolitan and where there are plentiful jobs, we're going to continue to see these increases of prices as long as interest rates stay in the levels that we've seen them, between that 4 and 4.5% range. That this is likely to continue for some time now.
And you're making a very interesting point, Ryan, about how uneven it is, because if the national numbers show that there are poor job numbers, that means the QE continues. If the QE continues and you're already in an area where you have a job and jobs are plentiful, then housing prices will continue to rise in those areas. That's correct. Well, if you think about it on a national level, if people are not getting jobs or getting part-time jobs and not being paid much for those jobs, you would think housing prices would drop.
Right.
Because it would have to match the ability of the worker to purchase the home and get a mortgage commensurate with their earnings.
Yeah, what's interesting too. I looked at the ADP report. And I don't ever put any stock in that report. But then I looked at also from the NFIB, which is the National Federation of Independent Business. They put out a statement on July 31st, which was few jobs and poor prospects. The chief economist for the National Federation of Independent Business, William Dunkelberg, basically issued the following statement on July's job numbers, which was essentially that July was another slow month for jobs among NFIB's 350,000 owners, with the average increase in employment coming in at a negative 0.11 workers per firm, the third negative monthly reading in a row. Now, isn't that interesting that pretty much coincides with the report that we've seen today from the BLS? And I would put more stock into, somebody coming from a chief economist, so basically somebody that's, comprised of a bunch of small businesses. You know what I mean? Versus some of the takes, and then I always feel like these reports are skewed based upon how they arrive at these numbers, because I think it's the ADP, they take a lot of payroll data, and they kind of, I guess, arrive at their numbers through a bunch of data sets, versus this is they're actually polling, business owners here, and they're saying, are you hiring, are you firing, and what's the deal? Because that's what we should actually be looking at. And I think that if all small business owners were saying, hey, yes, I hired another employee this month, then that to me is something positive in saying that, right, well, there must be something going on that's allowing these small businesses to be able to incur more expenses, right? And the fact that we're not seeing that, and I don't care what any of these other reports say, but if we don't have small business growing, if we don't have small business hiring people, then our economy really isn't moving in a positive direction, as much as the president or anybody else for that matter may seem to think so.
Especially, Ryan, when they say, and the White House has said this, and so is their press secretary, Jay Carney, that they see no evidence of employers scaling back because of the pending Obamacare mandate. And you have examples of people saying that that's exactly what they're doing. White Castle came up the other day and say they may only hire part-time people.
Yep. And I even gave the example a couple of weeks back. Remember when I told you I walked into, I believe it was the Carrabba's restaurant? And right. I overheard the manager speaking that, hey, we're basically hiring double the amount of part-time workers, and this was something that they were implementing because they thought that Obamacare was going to kick in 2014, but now obviously it's been extended, but they're not changing their company policy and what they're going to do moving forward. So we're going to see a lot more part-time jobs, which that's
what we're seeing.
Yeah, we're seeing it now, and I think the trend is just going to continue to be more and more of that, especially in restaurants, retail places, where typically we do see increases in those type of jobs because they're very seasonal, and not to mention there's not as many full-time positions in that type of work.
And Ryan, if you think how companies operate, they are now structurally investing in managing a part-time workforce. So that'll kind of ossify as to how they run their business, how they do their modeling for financial projections, how they hire people, how they train people, how they run shifts. They'll eventually put in business processes which will make it not full-time, but permanent on how they operate their business with part-time workers. So those jobs won't even come back even if you were to eliminate the mandate. because they'll probably realize it's more efficient and cheaper to work with a part-time workforce if you manage it properly.
Yeah, absolutely. And I mean, it's gonna definitely help the business's bottom line as well by doing that, because they're going to be able to not have to offer all the benefits and things that they would versus a full-time employee. So it's going to add to their bottom line and probably make them a bit more efficient. And all these things that were put in place. I say this time and time again, but you're not going to outsmart a smart business owner. You know what I mean? They're going to have to adjust, or they're going to go out of business. And
there's another thing that people will do, Ryan, is also with the health care plan, is the way they've set it up. You're not even going to be able to outsmart just an average person, forget a business owner, because it's cheaper to go without insurance, pay the fine, which is cheaper than if you had to purchase a plan, and then if you get sick, because the way the health care Obamacare plan is written, you cannot be denied coverage for a pre-existing condition. So many people will just forego buying the health insurance, pay the fine on their taxes, and then if something happens, they'll just go and get insurance.
Right. Yep.
I mean, the plan wasn't well thought through, because that's one impact, and you can't even say it's an unintended consequences. It's plain on its face that that's how it's designed. And similarly, with the part-time workers, when you put in a requirement that they have to pay, the employers have a mandate to pay healthcare over 30 hours, well, then they're just not going to go over 30. And the other one was, what was it, if you had more than 50 workers?
Right.
Well, what are you going to do? You're going to make sure you don't have more. If you have 48 workers, you're not going to go to 50.
Yep.
And if you have 53, what are you going to do? Bring some down so you get under 50.
Right. And then isn't it, I mean, and who is that primarily affecting? The small businesses, right?
Well, it's affecting everybody. It's also affecting the people who want a job at these small businesses, either at full-time position, or they want to be that 50th employee, or they're the 52nd employee and they don't want to go part-time.
Right. Yeah, I mean, it's definitely the implications of all this stuff that, is far-reaching. And, I don't really see, especially, and we'll kind of, segue into the Fed, and the Fed obviously spoke on Wednesday on their interest rate policy and whatnot. They left their key interest rate unchanged and reaffirmed that the previous guidance that they could continue to purchase $45 billion of U.S. Treasuries and $40 billion of GSE mortgage-backed securities each month. They also reaffirmed that they would increase or decrease the level of monthly bond purchases if they thought the economic data would support it. So once again, they're back out saying that, hey, we never really said that we were going to taper. We're looking at the data here, and if the data says that we must add more QE, then we'll do it. And if it says that we need to pull back, then we'll pull back, which is not what they said a couple months ago, Louis.
Right, and the data has always said that, if anything, they should increase if you think the way they think, that somehow QE helps support the economy because the economy is weak, as Bernanke has said. So talking about tapering goes against their belief that somehow QE helps the economy. They only say they're going to taper because they do not want to give the impression that this is a permanent, because they have no way out, that this is a permanent feature of monetary policy, is to continue to pour money into this system. And they're afraid of what might happen if they stop. So, but they don't want people to think that it's permanent. So you nailed it. They come out, Ryan, and they say, oh, we got to stop. And then something comes up, and then they pull back from it. And they like that kind of dynamic because they don't want it to get too far ahead of itself or behind, meaning they don't want rates to ratchet up as they did when they started talking about taper. But they also don't want them to go too far down either. So they've basically created this kind of, and the data helps them. As different data points come out, everyone looks at it and goes, oh, does that mean taper or not taper? Well, today it means not taper. But when the GDP came out, it looked a little better than it was in the first quarter, so maybe they might taper. And they want to keep it in that range. But I think, though, if anyone is looking at the data, not in a cheerleading frame of mind, then none of the data is any good. And Bernanke has said that if they were to raise rates, the economy would tank. And he thinks, though, he's trying to make the difference that somehow he can keep rates low just by keeping the interbank rate low, the Fed's fund rate low, without QE, and that is 100% false, because if the Fed is not out there buying in full force $80 billion, rates will go higher.
And that'll happen instantly.
That'll happen instantly, and this is not like in the past. People keep saying, and it's false, Ryan, that interest rates rise because the economy is doing better, and if rates rise, don't worry about the stock market because it means there's a healthier economy. Yeah, that's normally true if the Fed isn't buying the bonds. If the rates rise because the Fed stops buying, that has nothing to do with the health of the economy. And they know that the health of the economy is based on low rates, not because the Fed says rates are low, but because they go out there and make sure they're low through the quantitative easing program.
Well, and you and I had talked. Okay, so let's say they're not buying $85 billion. What would be the private participation of investors to buy these treasuries and these mortgage-backed securities? It wouldn't be there at all.
We don't even know because, they're buying 90% of them.
Right. So we don't. They probably.
And Ryan, think of the people who are buying them. They're only buying them because they know the Fed is buying them and backstopping their purchase.
Exactly. Yep. And so it's basically, if the Fed's doing it, then I feel comfortable putting my money too. And the interesting thing is because what benefit would an investor have to invest in mortgage-backed securities at like the 4% or 4.5% level? They wouldn't, right? If this was a normal market and everything was going great, they would probably push up closer to that 6% range, where it would make more sense for them to jump back in to assume the risk that's associated with these securities.
The normal market risk. Right now what they're calling it is interest-free risk. You buy a treasury today, you get nothing, but you have the risk that the Fed stops buying them, and that's why when they were talking taper, the 10-year went from like 1.3 to 2.6 in 4 or 5 days.
Yeah. Yeah.
Because people know, wait a minute, there's a possibility now. They're talking taper. And then, of course, as you mentioned, once they say, oh, no, Bernanke didn't mean that, and Bernanke comes out and says, I didn't mean that, and then they change the note to say the recovery is not modest, it's not moderate, it's modest. And I say, oh, okay, so they're not going to taper. And then they throw in that increased language again, so people get more comfortable, rates come back down, and they continue to buy. Yeah, and when they continue to buy, rates stay low.
Yeah, and it's funny because, I believe you wrote an article on the Fed and their decisions this week on your blog, schmoggled.com, which is SMAULGLD.com. Would you like to kind of touch on what your blog post was about? Because it definitely I think is interesting, and the article was the FOMC meets and their decision.
Well, that wasn't really a blog post. I just said picture of the little rascal kids throwing the money out the window. And basically, that's just how I view what the Fed is doing. They're throwing money at the problem. We're not seeing results. We're 5 years into QE. Unemployment rate is down, but only because people are leaving the workforce. So that blog post is just symbolic of what the Fed is doing. It's not really much of an analysis, but it is humorous, and it did get quite a number of visits when it was posted.
The other one I meant to talk about was actually the dark side of rising home prices, where you went into depth about Bernanke and what his response was back in 2005, and then now what's actually happening and could potentially take place from this, from these artificial rates in the 4 to 4.5% level. They were in the 3 and 3.5% level. Obviously, many people are out there that were thinking that this train wouldn't stop, and the interest rates, they didn't have a choice but to stay low because that's just what happens. And obviously we're seeing now we've had huge increases in prices, especially in the DC metro area. I'm sure that it's probably going to be the case in many metropolitan areas. I know Florida's heating up. But a lot of the buying that's taking place is investor-based. It's a lot of cash deals, not as many people that are taking out mortgage applications, because as we know, there were about 80% of mortgage applications that were refinance applications. Well, now that interest rates have gone back up into the 4.5% level, you just basically eliminated all those applications. So what's going to be really interesting is to see that mortgage application number over the next 6 months. Because when you have almost 1% to 1.5% increase in interest rates, I guarantee you that's going to change. change things quite a bit. Now, and we have inventory levels that are somewhat low, right? Especially in metropolitan areas. I mean, houses are coming on and they're flying off the shelf just because there's not much there. But you and I noted that as interest rates rise, this will start to change, and we'll start to see these homes sitting on the market for longer periods of time, especially in certain price ranges that as they go higher. People.
An inventory shortage is not the same as a housing shortage. There's nothing structural about the fact that there's fewer homes on the market. Eventually, more homes will come on the market as prices rise, as home builders build. And what I'm worried about is precisely at the time when demand drops.
Right.
So you get an entire reversal of the supply-demand dynamic, and then your housing bubble kind of comes to an end. And that's what the Fed is going to try its hardest to make sure it doesn't happen by keeping that demand high, by keeping the demand high, by keeping interest rates low.
And that's the only thing that they can do, because the only other thing that could change the demand is for there to be this huge spike in employment, right?
Oh, sure. And they can't, and you think about it, the mandate of the Fed is to full employment. They can't influence that at all.
No. Nope.
And unless you have those jobs and a vibrant recovery, meaning in employment and economic activity, they won't be able to afford houses other than you make them almost free by keeping interest rates low. But you've pointed out during this entire time for 3 years, Ryan, that those low interest rates mean nothing for most people because they don't have access to them.
Correct. Yeah.
And you really have a problem.
Yeah, and I think that it's, from a consumer's perspective, when all they're doing is, reading the newspaper, watching TV, going on the internet and seeing, interest rates at all-time lows and housing values skyrocketing, it automatically, puts in their head, hey, I need to jump in because I'm missing out on something, right? So then they go on their quest to start their home search or to figure out if they're able to buy, only to find out that, it is extremely difficult to get a home loan right now. And there's another bill that's going through Congress right now for FHA stuff, for government-insured loans, that is actually probably going to make it even more difficult for you to obtain a government loan because of what they're doing as far as the indemnification process, that they can come after the lender and make them probably, they haven't said for sure, but I'm sure this is what they're trying to do. They're trying to raise up the insurance premiums once again, and they're also trying to be able to come back after the lender to make them buy back loans, okay? What that tells me is that they're having a lot of default, people that are defaulting on their government-insured loans. So now they want to be able to come after those lenders and say, hey, no, we don't, you're buying this loan back from us. Well, if that's the case, do you think that the underwriting guidelines are going to get even more stringent?
Of course they are. And, Ryan, you know what that'll do? That harms the mom and pop because now it's going to make the lenders more reluctant to lend to them, and that favors then the cash buyer and the investor who doesn't have those issues.
Yeah, and it's so counterintuitive to me because it's like, okay, there's, we have Congress and the Fed and everybody saying that, housing's doing great. Who is it doing great for? It's not doing great for the average Joe because they can't even obtain a home loan. And I can't tell you how many clients that I've personally worked with over the last year that they're in a situation when they want to buy that they're not going to be able to buy for probably 6 months to a year because they've got to either get their credit straightened out, they've got to get their income, their job situation straightened out. It's not as simple as just saying, hey, I want to buy a house and going out there and buying it. Typically,
and add one thing to that, Ryan. If the Fed has its way, because it's in love with rising home prices, 6 months from now and they've got everything in order, the home price is out of reach because it's gone up another 20%.
Right.
It doesn't make a stitch of sense to be supporting higher home prices, and then to say that higher home prices are not included in inflation when that's your number one cost of living. So if home prices go up and rents go up, and then you claim there's no inflation, but your finances are more restricted because you're paying more for rent or your mortgage, then of course there's inflation. And so they wouldn't push higher gas prices as a good thing or higher any other prices as a good thing. But for some reason, higher home prices are a good thing because they want people to think that they're rich because they're sitting in a home doing nothing other than sitting there, and the home price goes up, and then they want them to then take out home equity and spend the money.
Right.
That's not really the basis of a productive economy.
No, it's not. And, but, the flip side to all this is, and we talk about it week in and week out, is that, okay, so for the people that are able to take advantage of mortgages now, I mean, if you're able to get 1, 2, 3, 4, 5, 6 of them, however many you could possibly get, because you do qualify. If you are in a position, then you should be taking full advantage of that right now. I mean, this is what's been given to us. So if you have the means to do it, then do it. And if you're unsure if you have the means to do it, then find out. I'm not even saying that you have to go forward and buy a house, but at least find out if you have the capability to. Because what you might uncover is that, well, hey, I didn't know that my credit score was this, or hey, I didn't know that there was this underwriting guideline that says that I have to be here. There's so many different things. You can actually, go through the entire process of getting pre-approved so you know where you stand. And take it a step further. Find out today, if you got qualified, what would your price, what would your actual housing cost be? Meaning, let's say you assumed that you had an interest rate of 4.5%. And then let's say that things got worse over the next year or two, and now interest rates are at 5.5%. Well, how would that change your situation? And then also take into consideration a higher home price. So let's say that values went up another 5 or 10%. These are all things that you should be thinking about. And, I
and rent, too. Compare that to what your rent is or might be now and a year from now.
And also factor in that your rent can rise annually, and because they have. So these are things that you should be paying attention to, and I know it's probably difficult because most people are just thinking about tomorrow and don't want to think into the future. But as far as mortgage rates are concerned, I think that it's a very, very important thing right now to figure out where you're going to be in the next year, 2, 3, because all this could come tumbling down and just completely falling apart if and when the Fed would start pulling back their MBS purchases. Now,
or loses control over the ability to control mortgage rates. And you and I have been astounded how well they've controlled them. Really, up until the last couple of months, they've managed to drive them lower and lower and not had the volatility with these spikes that we've seen in the last month or so.
Well, I'm actually shocked at how when they basically had, when they opened their mouth and then basically backtracked, I thought that was going to, really have them lose a ton of credibility by doing that. But apparently Wall Street is completely blind, and they just have to buy into everything that the Fed's doing, right? Because
the same thing. Yeah, they want the Fed to have credibility because they want the Fed to say we're going to keep QE going and the party going.
Exactly, because they know that the only way that the party will continue is if the Fed does this.
If the Fed loses credibility, then their whole job as stock traders and stock promoters and flipping houses ends. So they don't want they have no vested interest in making Bernanke look like a buffoon.
Yeah, and it's interesting, too.
They want him to be the grand wizard, and they do not want that curtain pulled back.
Well, what's curious to me is that, okay, so that's from the stock trader's perspective. But these economists that are writing these long essays and white papers on what the Fed's doing and how they think that they're handling things correctly, what are they paying attention to? What are they looking at? Because, I mean, it doesn't make sense that, if you could be an economist and look at this and say that this is some sort of even close to normal economy. I mean, this is a disaster.
You know what it is, Ryan, that economists, as we label them, have grown up in a system that presupposes that the way an economy runs is through government interference, stimulation, and central banking. So then using it as a starting point that the premise is these are actors in an economy, then all they're doing is commenting on how much activity the governments and the central planning and the central banks are doing. And they're judging their actions on that basis rather than saying, wait a minute, do any of these actions make sense in an economy? Should they be doing them? So they don't start from the premise that economies and markets function in a certain way. They actually start with the premise that's already been given to them that they don't function properly, and you need government intervention. You need central banks to interfere in the economy. And, of course, the economic profession is basically paid for either through academic, meaning colleges, which are publicly funded, or through banks who have a vested interest in a dovish monetary policy. So real economists as I would call them, maybe Austrian economists who view economies as unfettered, would look at what the Fed is doing, so they shouldn't be doing it all, whereas all the other economists are just looking at different shades of gray on how much the Fed should be doing, how much stimulus should be in there, how much should we tax, where should we tax, how should we tax, not should we tax.
Yep. Well, what's interesting, I was reading a blog article, I believe it was KCNblog.com, I believe it was on, and it said there are 3 great reasons to consider buying a home today instead of waiting. The number one was prices will continue to rise. Okay? And it goes into detail. The Home Price Expectation Survey polls a distinguished panel of over 100 economists, investment strategists, and housing market analysts. Their most recent report last week, which was released last week, projects appreciation in home values over the next 5 years to be between 12.3%, most pessimistic, and 32.8% most optimistic. The bottom in home prices has come and gone. Home values will continue to appreciate for years. Waiting no longer makes any sense. Now, that just says that they're drinking the Kool-Aid to no end.
Of course. So how are people going to make 32% more to be able to afford a 32% increase in home prices?
Absolutely not.
Well,
I mean,
because they want home prices to go up, because somehow that's good for the economy. People move in and out of houses like musical chairs, and that helps the economy. And, in 2005 they were saying home prices will continue to rise. Of course. And Bernanke said, well, they won't decline in 2005. He said that I disagree with your premise, Maria. He was on CNBC, that we've never had a nationwide decline in pricing. Well, yeah, we never had a nationwide increase up to that point that we had it so great. Of course, then when prices ratchet up in any market, whether it's housing, when you get double-digit raises in price of any asset for an extended period of time, they correct. They don't just keep going up. But, of course, on the way up, you feel like it's a inevitable supernova, and you're just going to continue going up. You can't look at even with gold and silver. When you have parabolic rises, gold went up 12 years in a row. Now, that's because the money supply was increased. But still, eventually you get corrections. No asset goes up. No asset class goes up 6-7 years in a row at 20-30%.
No.
Especially one that isn't dynamic like housing, which is totally a function. There's limits. It's not like an internet where you can continually get more users and so on. There's a limit to how much people can pay based on how much they make to drive up home prices.
Right. And then it would be one thing if as interest rates go down, people's purchasing power goes up, so they're able to afford more. But it's not the situation that I would like to see, which is wages are going up, therefore people can afford more, right?
Sure, but there is a limit to your first example. Interest rates can only go down to 0.
Correct.
Okay, and if your wages don't go up, there's still a limit at 0% how much you can pay a month for a mortgage.
Yeah.
You can't get, in 5 years, houses double. If people's wages don't double, doesn't matter what they pay in a mortgage, even if they pay no interest. They can't afford that price range. So for an economist to think that home prices can rise, they're forgetting who's going to buy them.
Oh, I agree 100%. They do. And, I mean, they don't – it's like they don't even pay attention to that fact. They're only focused, though, that, they got a chart somewhere. Exactly. They got a chart that just shows, well, we've seen this increase, and as long as interest rates stay at these levels and we can continue this projected path to get – and that's just – I mean, if it does happen, it would be – I mean, I don't see how it possibly could, number one, because there's not enough people that are qualified to buy these houses, and I don't think that there's – at that point, it would be so much investor saturation in the real estate market that people would really –
crash.
Yeah, it would completely crash, and we'd be revisiting what we just came out of not too long ago.
But that's what they're looking to do. That is apparently the whole MO of QE is the only way they can stimulate the economy is get people moving in and out of houses at higher prices and then move the stock market up and hope people spend money. And to a certain extent, that's where they finally succeeded in the last 6 months or so. To cut it off now would make sense, but to cut it off now would take away all the so-called benefits they've created by getting people to engage in these activities. They don't want them to stop. They want the stock market to continue to go higher, and they want home prices to continue to go higher. The difference is the stock market actually has much more headroom. You can get PEs, and people will pay it 20, 30, 40, 50% because you can still afford $100 worth of a stock, whether it's at a 20 PE or 100 PE. But you cannot buy more house and drive the price up if it goes from 400,000 to 800,000.
No.
So they've got much better opportunity to manipulate the stock market. And then they can get people justifying the high PEs, and it's different this time and so on. But eventually this all has to stop, doesn't it, Ryan?
Absolutely. I mean, much like the housing market, the stock market, with the access to cheap capital, this can only go on for so long, right? And that party is going to come to an end as well. I mean, stock market over 15,000, it's just, it's insane to even think that it's there. For the real estate market to have, interest rates at even the levels we have today for such an extended period of time. I mean, it seems ludicrous to me. And I mean, like, I know that, people like to go out there and pump, whether it's NAR or whoever it is to say, this is just such a fantastic opportunity. I mean, don't get me wrong. I think that it's a fantastic opportunity, but I'm more questioning why it's a fantastic opportunity, and it's because of all the manipulated markets, which I don't like. I would like to see more of a normalized market because then you don't have to worry about such vicious swings up and down, right? I mean, so like you said, inevitably what's going to happen is the equity positions are going to go up in people's houses, and people don't like to save. They like to consume, so they take out more loans. So you're going to go and then you bought a house for $300, it went up to $500, so then you take out a mortgage for $450,000. So then you just increased your loans, your monthly debts went up, and you got that cash and you went out and you didn't put it in the bank. You probably spent it on, home improvements or landscaping, anything else you want.
Vacation. Right.
So that money now disappears in the thin air, right? It's gone again. You're paying it back as a debt. So I don't like the vicious cycle that takes place because we've already seen what happens.
Well, then the price of home goes down, and now you're underwater again.
And we're doing the same thing all over again, right? Foreclosures and short sales. That's why you and I had talked about this a while ago that this short sale stuff is not going to stop. It's going to continue because it's going to be we're going to be right back in the same boat, whether it's 5 years from now, 6, 7 years from now.
I think it'll be a lot sooner, Ryan. I don't think this is sustainable at all.
Still right now. It's still going on right now, like I said, we'd have to have another 30, 40, 50% increase in prices to get those people that were really bought at the height to get them out from a negative situation, and that's not going to happen. It can't happen like you said.
Well, in certain areas they're ahead. I know in San Francisco, in the Bay Area, out in California, prices are higher than they were at the bubble. Now, that's not the magic holy grail to reach, is the 2005 bubble prices, because they weren't sustainable in the first place. It's only those people that bought then that need to get those prices back to get above water. Correct.
And, many of those people that are in those situations right now are saying, okay, what do we do? Do we go ahead and try to rent this? But if they try to rent it, they have to be able to carry that existing mortgage payment against their debt load in order to obtain a new mortgage. Many people can't do that. Many people can't carry two mortgages and be able to qualify. That can't happen. So then they say, well, I feel like we're stuck. And I don't want to keep paying into this mortgage because I just feel like I'm throwing away or I'm putting good money at bad money at this point. So then they say, well, should we consider short selling? And then they have to wait 3 years before they can buy again, but then they could rent and save some money. So there's a ton of the strategic short selling going on still to this day, and that's not going to stop. It won't stop. You have, obviously, in many instances, there are hardships for people who have lost their job or their hours have been cut back so they can't afford their mortgage. But believe me, there's a lot more people out there that are saying, you know what, we're never going to get out of this negative equity position, so we're just going to go ahead and get rid of it now, whether it's through short sale or they let the bank take it back.
What about, Ryan, the people that are in the circumstance where they've now come up above water? A lot of those people are waiting for the day so they can get their house on the market. And as that happens, you'll get a lot more inventory on the market.
Correct.
You'll get the short sales. We'll finally throw in the towel. The banks will start to release foreclosures more, and you'll have the people who are now above water figure now's the time. I missed my chance last time to sell. I'm selling now. So your demand is, the inventory shortage will go away, but precisely, I think, at the time when the demand goes down. And that's what the Fed has to avoid, is demand going down. And they can only influence demand through interest rates. Again, if you don't have a job or you're a part-time worker, you're underemployed, it doesn't matter how low interest rates the Fed makes them. You can't get it. So they can't even really drum up demand through that. And that's why the housing market, I think, is the weakest in the bubble economy that the Fed has produced. The stock market they can get away with.
Right. Yeah, what's it like they just hand over money to these banks so they can invest and buy up things in the stock market and try to make, double-digit returns or whatever it is. They never said, hey, we're going to give you this money, but, there's preconditions to you receiving this money, which means that you actually have to lend it out to people, right?
But, Ryan, the banks own the Fed, so it's like them telling themselves, we're going to give you money, but we're not going to let you do anything with it.
Well, I agree, but you know what I mean. It's kind of like, they're all this free money is out there, but it's not for the consumer. You know what I mean? They make it seem like these interest rates are available, but nobody wants to lend. They're not going to. They sure aren't going to lend to, and many banks don't even like lending to real estate. Period. As a matter of fact, it's
very labor intensive.
Right, and I've probably talked to 15, 20 different small banks because I flip houses myself, so I understand the process. I understand what banks are looking for. So in talking to numerous banks, I would say of the 15 or 16 that I talked to, I would say that probably 12 to 13 of them just point blank told me we don't want anything to do with real estate. Okay, they don't want anything to do with it. Now the other 3 or 4, they would say, well, we're willing to do it, but we need to see this proven track record. We need to see 5 years worth of tax returns. We need to see. I mean, they basically need to see everything but your death certificate. You know what I mean?
It's a lot of work.
Yeah, it is. And so.
And if you remember, Ryan, in the 80s when the investment houses had the big switch over in power internally from doing real banking work, which meant going out and identifying opportunities, funding companies, investing in those companies, that was the bread and butter of investment banks. But that switched in the 80s to trading, and it's gotten, 90% of the revenues come from, not from the traditional investment banking, but from this type of high volume, high frequency trading. And that's what, that's what people want to do. They don't want to put the time and effort into something no one does. If you can just have money wired to your house, Ryan, you wouldn't be out working.
No.
Doing something else. So obviously that's what people do. And if real estate is a labor intensive and somewhat higher risk, then they're not going to do it. They have less. I think EverBank just pulled themselves out of the mortgage market.
Yeah.
Did you see that?
Well, what's interesting, I heard the same thing, but what's interesting too is, why would you not consider getting out of doing mortgages if, you're only able to lend out at, 4.5%, right? Realistically.
The only reason you would do it is if house prices go higher, at least you're doing a higher volume, I suppose. The mortgages are going to be bigger.
But see, that's the way these mortgage companies are making their money is on volume. It's not, they've got origination fees and all the other junk fees that are in there. You know what I mean? So they're making other fees, but realistically, if it's not done on volume, then it's going to put all these mortgage companies out of business. Which is another reason why it's important for interest rates to stay somewhat low.
Well, also you're making another point, Ryan. This housing recovery is more based on how home prices appreciating than it is on the volume of homes being sold. By definition, if you have this inventory shortage, means that there aren't as many houses for sale. And we pointed out last week that the number of new homes being sold is a third of what was being sold in 2005, which means there's not the volume of turnover on homes being sold, which also means for the economy, there's fewer construction jobs, there's fewer jobs associated with the production of new homes because they're not really producing them at the same levels. So that highlights that this demand isn't really strong. It's just that there's a low inventory.
Correct.
But again, low inventory is not a housing shortage. It's a temporary situation.
Yeah, it's a temporary situation because, as we discussed, there's many people out there that are still upside down in their house and they can't do anything with it, right? So if
they still have a house though, and that house still exists, it's perfectly functional. There's not a shortage.
Right, and the
why should he sell though?
Well, the only way that he could sell right now is if he decided that he wanted to take money out of his savings or 401k and bring it to the table, right? But how many people want to do that?
No,
yeah.
And the other thing is, I pointed out in the blog post earlier this week, that's a drag on the economy because that person probably can get a job somewhere else, but they can't sell their house.
Right.
So they're stuck there. So you have an immobile workforce that might be able, like that person maybe lives in California, could move to Texas, but doesn't want to have to pay to move.
Yeah.
Yes,
there is one for military people. I will bring this up because I think it's important for military people that do have like a VA loan. Like let's say here in Virginia, but then all of a sudden they're going to get relocated to another state. They're one of the few that they could actually potentially take out a second VA loan because they're given so much entitlement that if they move, they can actually move and take out another VA loan, which is 100% financing again. Now, they're limited to the amount because they've already used a little bit of their eligibility on their first home, but they don't have to count that other payment against them if they will get it rented out.
Okay? Oh, that's good news.
Yeah, so that's another positive.
Do you work with those types of loans?
Yes, VA loans, we do those type of loans all day long. They're actually, I mean, for people that have the eligibility, that have their VA eligibility, they're the best loans out there, to be honest with you. Because, I mean, you're getting 100% financing. There's no mortgage insurance. Yes, you do have to pay a funding fee, but you can finance that into the loan. It's basically the cheapest money that you can get. Because it's really, you're not having to really put any skin in the game, and that's kind of what you're given as being, a veteran. That's one of the benefits you get.
And Ryan, do you know what the default rate is on a VA loan compared to other loans?
Very, very low. It's the lowest in the industry.
Okay.
Yeah, and what's interesting about that is because I think it has more of the military background to do with it than anything else. It's kind of like they're given this, they're almost scared to default on a VA loan. You know what I mean?
It's like going AWOL.
Exactly. Like you don't want to do that, right? You don't want to be that guy that screwed up his VA loan. So I think that has more to do with it than anything else. But I think it also proves that there's certain lending guidelines that if you adhere to them, that people can be successful lending out to the right people. And I think that sometimes the indicators that people are looking at, they get so caught up now. I mean, I'm telling you, some of the underwriting guidelines, like if you've got a large deposit in your bank account that's over 25% of your average deposit that month, that you automatically have to show documentation of where it came from. So let's just say that number was 1,100 and it's 1,150. You got to document it. I mean, how many people put money in there? But these are the types of things that can blow deals up, because guess what? If you can't document a large deposit that goes into your bank account, your loan's not going to get approved.
Well, Ryan, go back to our earlier discussion today. These are all governmental guidelines that don't account for a free market, because clearly if somebody was going to do a credit analysis on somebody, not pursuant to government guidelines as to whether they think this person is good credit risk, they would make loans in many instances.
Right. Yep.
And these guidelines prevent, we talked about the small business owner, they're probably the best people to loan money to, but they have the hardest time to get a loan because it's hard for them to meet the income requirements.
Yep. They don't meet the income requirements because they want to pay attention to tax returns, and they're saying, oh, well, you've expensed too much of this stuff. You're not showing enough income. It's always that song and dance, and they would lend on, your accounts receivables or something like that. But try to just get a regular business loan to expand your business. You got no shot. And it's unfortunate because, there's businesses out there. Now, I'm not saying there's plenty of businesses right now that are growing. And, these aren't, these are small businesses that started from the ground up, and they're still, but it's private capital that's financing a lot of these. I mean, as you've seen, probably Lewis Online, I mean, there's a lot of privately funded companies, and they have these crowdfunding sources such as like Kickstarter and all these where people are now, they're like, you know what, I got this genius idea. The bank is not going to lend, so why don't we go out and see if we can actually get, everyday Joes to put their money in for products and services that they want to support.
And is that really, do you know if that's taken hold? I know there's anecdotal evidence of it, but how much money is actually, in terms, amount invested?
I want to say last year it was almost $3 or $4 billion. It's
not bad. It's not that much.
They said that they're projecting that to double in the coming year. So I think that this is like something that's on the, it's still on the up and coming. But
it removes the chokehold of having to go to the bank.
Yeah. Well, I mean, it's pretty cool. If you guys ever get a chance, go to Kickstarter.com and just check out some of the things that are on there. There's different products that what they do is they offer up. If you put in $100, that you're going to get one of the products that they're building, and they have so much time to complete it. Like they're only given like a 45 or 60-day window to complete it, and then they extend them. They'll be like one of the first ones to receive that product. So you get to really support things that you that you feel like would be a success or that you're interested in.
And you know what the problem with this is going to be, Ron? I can see it right now. All there has to be is one high-profile fraud case on Kickstarter, and they're going to use that as a reason to shut it down, even though there's high-profile fraud cases left and right with full Securities and Exchange Commission oversight happens in plain daylight. But that'll be a reason to say the poor mom-and-pop investors are going to get ripped off. We got to put regulations on this Kickstarter.
Well, yeah, and they've already been talking about, just imagine once they start to open this up to, if somebody invests their money in this company and they take an equity position, right? And something gets screwed up, you know that it's gonna, I mean, I can see the government jumping all over this because, you know.
But what happened with Facebook? Nothing. When Facebook came out and there was all types of problems with that IPO, nothing happened. Or when this Corzine guy supposedly didn't know where the money was on MF Global, nothing happened there.
Yep. Yeah. So, I mean, I think that, you know, private capital and private funding is definitely the wave of the future, but mainly because, you know, somebody finally said that, I guarantee you that started from somebody that said that, well, I can't get a loan to start my business, right? So what am I going to do? I mean, you basically have to go out there to venture capitalists who basically want to take everything you have before they'll give you any money.
That's true.
You know, I mean, they want to take 50 or 60% of your company, and then you don't really even have a company by the time they get done with you.
Put their guys on the board and, you know, basically tell you how to run the company so they get their exit.
Right. So, I mean,
but they have the right to do it. If they've got the money, those are the terms that they dictate, so to speak.
Yep. Yeah, and I mean, so it's unfortunate that, you know, I mean, it's actually not unfortunate. I definitely like it because it gives people an avenue now where they don't just, they have an idea and they, you know, it's just the capital that they need, and they can push that info out there, and they can get supporters for it. They can actually start their company, which goes back to what you and I were talking about, Lewis, which is not necessarily having to go to college or any other type of schooling to actually start a business. You know what I mean? It takes some innovation, it takes some creativity, and with the technology that we have and the ever-evolving internet, I mean, there's so many different things and ways that you can get involved, especially if you don't have a job right now. The world has
absolutely. If you don't have a job right now, you shouldn't be waiting for the employment situation to change or go back to school. You should be thinking as if you don't have other options. The school isn't an option. Waiting for the economy is an option. Go out and do something.
100%. I mean, I believe that, you know, you got everything right there at your fingertips if you can get on a computer. And if you don't have a computer, you can go to a local library and get on it there. I mean, you have all the books at your disposal there, and you have the internet. It's a great place to start.
And now they have things like meetup.com. You can meet other people who might want to be involved in what you're doing. You can make your way a lot easier now than you could 50 years ago, especially if you were isolated living in a small town.
Yep.
Here you're not so isolated anymore.
No, not at all. Not at all. I did want to jump into this week's credit tip of the week. It's less of a tip, but Louis, did you see that that Equifax has to pay out $18.6 million to a lady in Marion County, which is in Oregon? $18.6 million after she spent 2 years unsuccessfully trying to get Equifax information services to fix major mistakes on her credit reports.
$18.6 million?
$18.6 million. Yeah, that's not a typo. And once again, this goes more to the thought there that the credit bureaus really don't care. They don't care if they have to pay out millions and millions of dollars in fines and in lawsuits because they're making that much money, right? And it's easier for them to just avoid fixing stuff and for them to just go to court with the one or two people that want to sue them. There's lawsuits all lined up all over the place against them right now. But they don't really care. They'll pay them out, and they'll keep moving forward because they're making so much money. But $18.4 million, and it was basically that was $18.4 in punitive damages and $180,000 in compensatory damages.
Yeah, that's what I was saying. She can't really be damaged that much, but it's the punitive damages they got them on.
Correct. But she contacted Equifax 8 times between 2009 and 2011 in an effort to correct inaccuracies, including erroneous accounts and collection attempts, as well as a wrong Social Security number and birthday. And yet, over and over, the lawsuit alleged that Atlanta-based company failed to correct its mistakes. So, more of what my point is here is that she actually went through the legal process and actually, sued, which is her right to do so. Now, had she called a professional credit repair company that has attorneys that understand that these errors were erroneous, she probably could have got them fixed in a month or two versus having to wait the 2-year period.
Yeah,
now,
but she wouldn't have gotten $18.4 million.
No, I'm completely thrilled that she got this money. But I'm saying
right.
for, everyday person. That's
not everyone's so lucky to get that.
Not everybody's so lucky to get it. But if you feel like, or you know that you have inaccuracies on your credit report, you need to be working with a legal credit repair company that they can basically look at your errors and say, hey, this is a mistake. They send a legal document over to Equifax. Don't think that Equifax won't fix it when they have an attorney breathing down their neck. What she probably did was she didn't actually go to an attorney to have them fix these errors. She went to an attorney to have them sue the pants off of them.
Right.
Right? That's what she did. But if you're looking to get into a home, if this is something that's preventing you from buying a home or refinancing a home or taking out a car loan or a credit card, whatever it may be, and as small as the errors it could be, whether it's a Social Security number, a date of birth, trust me, it's not going to say it's the easiest thing in the world, but there's professionals out there that specialize in it. I recommend the credit pros. I think that they're great because once again, they can set you up on a monthly subscription, so you're not having to pay them a huge lump sum up front. And really, they're going to take the time to get this stuff off of your credit report so that you can ultimately get a loan at a lower interest rate. So if you'd like the information, I can give it to you. It's the creditprosintl.com. The creditprosinternational.com. That's where I recommend you guys go if you're trying to get your credit straightened out to get any type of loan. But more or less, you stay on top of your credit because you never know when you're going to need your credit. And, you always typically find out that there's an error in the middle of you applying for a loan. So that's my tip for the week. We're up on the end of the show, Louis, but let our listeners know your blog again and where they can come to contact you if they have any questions, concerns, or they'd like to work with you.
Okay, thank you, Ryan. You can go to smallgold.com, SMAULGLD, and I have a daily commentary on real estate and economics. And if you'd like to contact me, talk about real estate consulting services, the About button has my contact information. And if you just check it out, you can check it out daily. You can subscribe to smallgold.com and get daily updates on what's happening with the Fed, the economy, and real estate.
Perfect.
So
I
check it out.
That, Louis. Thank you very much. We'll be talking to you soon.
Thanks, Ryan.
Guys,
thanks, everyone.
No problem. Thank you guys for tuning in. We'll be back again next week. If you have any questions in the meantime, you can reach out. I have a 800 number, 877-245-2030, or via the website. The website is being, like I said, it's under renovation right now. It'll be complete by the end of next week, but it's realestate360live.com. Thanks a lot, guys. Talk to you soon.
Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our podcast, my guest and I will cover basically every angle of real estate that you can think of, from interest rates to the economy to what's happening in Washington, what's going on with the Fed, the manipulation of interest rates, and what that means to you and your real estate and your real estate decisions. Joining me on today's panel, as always, is Louis Camerosano, who is a former school teacher, a former attorney, and a former general manager of a major real estate portal. Louis is often cited in the media as a real estate industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today, buddy?
I'm doing grand, Ryan. How are you?
I'm doing well. Obviously, I had a lot going on the past week or two. We've been talking a lot about the Fed and employment, unemployment, what that means to the overall economy. It's kind of interesting what's actually taken place this week, which I guess what we should start with, which was one of the bigger reports to the markets anyway, and carried a lot of weight, was that report that was put out by the ADP which is the ADP National Employment Report, which basically said the private sector employment increased by 200,000 jobs in July. Now, obviously with that report, now we had today, this morning, the labor statistics report, which basically came out and said that there was only, 162,000 in July, and the unemployment rate edged down to 7.4%. So obviously we have conflicting reports there. We also showed that the average work week was down. I believe it was average hourly earnings was down as well. Seems like there's a lot more trying to be pumped out there that things are turning around, and that just really isn't the case. I mean, what's your take on this, Lewis? I mean, this is obviously what we talk about all the time. It's like, they get one little piece of information, they run with it, which forced interest rates back up again this week, another quarter of 3/8%. Now, today, I would imagine we're probably going to get them to come back down a little bit based upon the information we have. But what's your overall take on the situation? First, touch on, what's going on with the employment situation. Then after that, we'll dive back into the Fed and what they talked about on Wednesday.
Okay, great. Well, Ryan, I think the report that just came out from the Bureau of Labor Statistics is not good at all. There's nothing to like in this report. As you mentioned, 162,000 jobs. Half of them are in retail and restaurant, which means more part-time work. You mentioned that the number of hours worked has decreased, which means more part-time workers. The wages have decreased, but yet spending is up by consumers. So none of this is going in the right direction. And also they revised downward last month's job numbers. So the amount of non-farm payroll that's being produced is low, and it shows that QE doesn't create jobs. Now, there was a slight bright spot in that there was an increase in some construction jobs related to the housing sector, but nowhere near the amount necessary to bring the economy back up in the labor market where it needs to be. And the most troubling point of all this is the unemployment rate may be going down, but that's solely a function of people leaving the labor force. And you have a labor participation rate tick down again, and it's at the lowest level in 32 years. So if you don't have people engaged in the labor force, or they're only partially engaged and they're making less money, you cannot claim recovery in any way, shape, or form when the people that are supposedly engaging in the recovery activity are engaged less, getting paid less to do it.
Right. Would you agree then that obviously these are more national statistics and not as much regional or even more specifically broken down into metropolitan areas, that realistically, in the smaller rural areas, not as metropolitan as New York, San Francisco, D.C., that these areas are obviously anomalies to the rest of the country, and that what this means to real estate is if, where there are jobs, it seems as though the real estate markets are doing much better. We've had rapid increases in appreciation of home prices. And then the surrounding areas elsewhere, though, where the jobs aren't as plentiful, and majority of the jobs are part-time jobs, that, this is more or less that from now until into the foreseeable future, that areas that are metropolitan and where there are plentiful jobs, we're going to continue to see these increases of prices as long as interest rates stay in the levels that we've seen them, between that 4 and 4.5% range, that this is likely to continue for some time now.
And you're making a very interesting point, Ryan, about how uneven it is, because if the national numbers show that there are poor job numbers, that means the QE continues. If the QE continues, and you're already in an area where you have a job and jobs are plentiful, then housing prices will continue to rise in those areas. That's correct. Well, if you think about it on a national level, if people are not getting jobs or getting part-time jobs and not being paid much for those jobs, you would think housing prices would drop.
Right.
Because it would have to match the ability of the worker to purchase the home and get a mortgage commensurate with their earnings.
Yeah, what's interesting too, I looked at the ADP report, and I don't ever put any stock in that report. But then I looked at also from the NFIB, which is the National Federation of Independent Business. They put out a statement on July 31st which was few jobs and poor prospects, the chief economist for the National Federation of Independent Business, William Dunkelberg, basically issued the following statement on July's job numbers,